This video is brought to you by Knowledge at the Australian School of Business. For more information, please visit knowledge.asb.unsw.edu.au.
Superannuation and wealth management is one of those industries where clients have been finding that over the past few years, the performance they've been getting has been falling short of their expectations. Now, a parliamentary joint committee has recommended sweeping changes to the industry to ensure that wealth managers put their clients' interests ahead of their own pockets. Peeyush Gupta is co-founder of iPac Securities. He's also executive in residence at the Australian School of Business. He's with me today. So, Peeyush, can you say, what's your reaction to these sweeping changes?
Well, hi, Julian. As we all know, it can be a long path between a parliamentary joint committee publishing a paper and publishing some recommendations through to the government actually then, looking through those and actually choosing to go ahead with them, let alone the passing of the legislation. And in what is an election year, one could have easily thought that perhaps the government may not have been too courageous in what it took on. But, in a sense, I'm pleasantly surprised in that they've embraced the essence of what the Ripoll inquiry, which is one of the three current inquiries that may impact the wealth management sector, the other two being the Cooper inquiry into superannuation and the Henry tax review. But, the government seems to have sort of come out quite substantially behind many of Ripoll's report's suggestions and have said that they're going to enact them. Probably the three key ones that I would sort of focus on is the banning of all commissions from 2012, including, and that there's a broad definition of commissions, including any upstream payments, volume rebates and the like. The second is proposing a higher test of advice, being a fiduciary test. At the moment, the advice that advisors give clients has to be appropriate to the client's needs. That's the current legal test. This is shifting it up a notch to be a fiduciary test. That is to say that clients' interests must be put ahead at all times of the advisors, and to the extent there's a conflict, the client must give informed consent to that conflict. And the third one, which also caught my eye, which was a bit surprising, was the government said that they will actually prohibit an exemption that currently exists, allowing accountants to give limited advice around self-managed superannuation funds. We have only about 700 sort of broad public sector offer funds in the country, but 770,000 superannuation funds. The vast bulk of them are in fact do-it-yourself funds, typically set up by accountants, so it's a big sector.
But surely it must be quite difficult to get somebody to move from a commission where they take a set percentage to trying to work out even what the fees should be.
Yes, look, this issue of fees is a vexed one, and unfortunately it's always the case that the last few percent of an industry, the one or two rotten apples, if you like, will really contaminate the whole barrel. By and large, whilst advisors may not aspire to be, but are probably not yet a profession, the truth is that the vast majority of advisors are ethical, principled, do genuinely have their clients' interests at heart and so on. Remember too that Australia has probably the most onerous, the most demanding legislation already today, and has been for some years, around the disclosure of interests. So unlike the US, unlike Canada, unlike the UK and so on, advisors in Australia have to put in writing whatever compensation they're going to get by way of commissions, fees or whatever, both in dollar terms and not merely percentage terms. So, as I say, I think disclosure goes a long way towards ensuring that consumers are informed about the decisions they're making. But I must say that there has been a few bad apples which did contaminate the barrel, and these legislative moves are about attempting to prevent those. Although I'm pessimistic, I must say, that legislation alone cannot prevent outright fraud or non-compliance with rules.
Then what would you like to see instead of the legislation?
I think one of the key issues currently in the whole post-GFC aftermath in respect of all financial services, not just really merely wealth management, many commentators have said is it wasn't so much that there was a lack of regulation, but that there was ineffective or insufficient enforcement. So I'd echo that sentiment. I think the first area that the government should start to think about is actually providing the various regulatory bodies with more resources, at the end of the day staff I guess, to actually police and enforce current regulation. And had that been done, I suspect some high percentage of the ills and problems that we've observed through the GFC actually would not have come about. The residual 20-odd%, there is some room for legislative tweaking and improvement and so on.
But equally, there is an issue in terms of how wealth managers are perceived, because after all, they've had something of an image problem over the past few years or so. How do you actually change that to get clients believing that their wealth managers are actually acting in their own interest?
That's a very good point that you make. In fact, what the data shows is that only 4% of Australians currently actually have a financial advisor. And if you survey the clients who participate and engage with the industry, actually there's very, very high satisfaction ratings. Well in excess of 85–90% of clients would rate their current engagement experience with an advisor as very good to excellent. But the big problem is the other 96%, those that have not yet engaged with, with my industry. And in some cases, that is due to the sort of poor perception that the industry suffers. So I think one of the side benefits of the proposed regulatory reform is it may help to sort of build further consumer trust in the industry, which I think long term is the interest, firstly of consumers, but also I think of the industry.
And it's part of that perception problem because accountants, up until now, have been able to run a self-managed fund and in effect offer almost advice for it. To move away from that, to have the legislation stopping accountants from doing that, is that going to help?
Look, it is a grey area. I think some aspects of advice involves tax and so on, and advisors do advise on limited areas of tax, for example, superannuation tax. Equally, accountants, I think, with some justification, would say that part of what they provide their clients is administrative, help and support, such as the setting up of self-managed super funds. But it is a grey area, and I think some years ago, when accountants who were generally giving it investment advice, not just incidental advice, which is the exemption, were forced to go out and become licensed, and that brings a host of compliance requirements, such as ongoing education, certification, and training, which I think has lifted the standards in the accounting segment of the industry. If for example, you look at timber and other rural sort of investments, the vast bulk of those, frankly, have been very poor products and have caused, investor harm, and the bulk of it has been sold by the accounting industry. So, whilst there's arguments both sides, I think it is better to actually draw the line and say that anyone that wishes to practice in this field must become licensed and must therefore comply with the ongoing training, education, certification processes.
But if you force people to get licenses, isn't that just going to promote a tick box culture?
Well, that's always the problem with regulation. You've got to ensure that it doesn't become black letter law, which can be satisfied by ticking the box, but not in spirit. And hence the room for supervision and enforcement and monitoring. Like any company as well, actually. So it's a lot of also about, I think, building a culture. And right from the US where, the Bernie Madoff scam and so on, where you have people coming out of the woodwork saying, we told the regulator there was a problem there, through to our industry here, such as Storm and so on. There's many people in the industry that have said, we told the regulator that there's a problem here. But I think if we continue to build on a strong and vibrant culture in the industry, then, as I said, the vast bulk of well-intentioned and good people who are in the industry will try and assist the regulators and the government and community at large to ensure that everyone that's sort of in that space does comply.
But over your 20 years experience of being a wealth manager, how difficult have you found it to become really client-focused as opposed to looking at the end-of-year accounts and trying to increase those?
Well, I think, look, in our case, the success of our business was, in fact, by being client-focused, trite as it might sound. And we always took the management view and philosophy that if we looked after our clients, then, frankly, our staff and our shareholders, including ourselves, would actually do well in the long term. One of the temptations, I'm afraid, Julian, in the money game is that there's always a temptation to cut corners and try and make money quickly. Now, whilst iPac was a success, it wasn't an overnight success. It took 25 years in the making. But because we were young and we were patient, and because really our key objective was not per se, making money, although that was important, it was actually about building a business, doing good things for our clients and for our people and our staff and so on, and eventually, as a consequence of that, doing well for ourselves. So we were patient, and I think if you're patient and sort of stick to your values, you can build a good business over time.
And finally, you've spent 25 years in the industry of wealth management. What have been the most important changes you've seen ever since you completed your MBA here?
Well, education is a lifelong affair. I'm sure much of what I was taught has since been superseded, if not outright recanted. I remember I had a heavy dose of finance in my MBA, and the efficient markets hypothesis was all the rage then, and some 25 years later it's still in the literature, but there is certainly some questions around the extent and the applicability of it and what the model weaknesses are and so on. So I think technical issues change. What hasn't changed, though, I think, is approaching business from a societal perspective. I think too often the debate gets lost, and companies are seen to, and business, frankly, seen to be an end in itself. And we need to remember that business and companies operate with a societal license. And in a sense, that's what the post-GFC debate is about. It's about the reminder that there are broader stakeholders, a broader community and broader societal needs that business would well be served to remember. And I think those were some of the things we were taught when I was taught as a student. I'm not sure that we necessarily understood the import of them till much later. But so some education is enduring and timeless, and other bits need to be refreshed from time to time. But I learnt the language of business in my time here, and I've used it ever since.
I'm sure it's an issue that we'll be talking about for many years to come. Peeyush Gupta from the Australian School of Business, thank you very much.
Thanks, Jim.
For more business news and analysis from Knowledge at the Australian School of Business, please visit knowledge.asb.unsw.edu.au.